So we start a new module today, banking and financial inclusion. Banking and financial inclusion. A very important module. You will get 3-4 questions every prelims from this particular module. Okay, so here we will discuss about all those concepts related to banking. Basel norms, everything will be covered in this chapter. It is slightly a lengthy module. Maybe I'll take 1 week for this. Five sessions I may take for this module. Okay, so let's start with the evolution of banks itself. So you can give a subheading under that, evolution of banks. Evolution of banks. So what was the first bank established in India? In 1720, Bank of Bombay. The first bank established in India in 1720, Bank of Bombay. Then in 1770, Bank of Hindustan. Bank of Hindustan. This one was Bank of Bombay. Okay, see, some books may tell you, and I don't prefer you need to go for any books or NCERT once you're done with this economic classes. Once we're done with this 20 modules, everything, your economy, NCERT reading and everything will be taken care by me. So only thing that you need to read after these classes is economic survey. So basically, if you are preparing for this exam, you only need to read economic survey. The problem is you may not understand economic survey, but once we're done with the classes, to update the current affairs and those values when you're going to write exam, you just need to read economic survey. Okay, so here some books will tell you this one, but RBI document, it is actually the Bank of Bombay. So for us, you can take it as 1720 Bank of Bombay. Okay, so the first bank established by an Indian, Oudh Commercial Bank. Oudh Commercial Bank, 1881. First bank established by Indians, Oudh Commercial Bank, 1881. Second, any idea? By Indians?
PNB.
Yeah, PNB, Punjab National Bank. Okay, so Punjab National Bank. See, this Oudh Commercial Bank actually closed, wind up in 1950. So we are not discussing this. Okay, so Punjab National Bank. This is the second bank, PNB. Okay. When, which year? 1894. This one 1881, this is 1894. Sometimes you may be asked to chronologically arrange and all these things, so you should be knowing the years also. Okay, the first bank established by East India Company. The first bank established by East India Company. Any idea? Bank of Calcutta, 1806. It was later renamed as Presidency Bank of Bengal. You can write that also. It was later renamed as Presidency Bank of Bengal. Okay, similarly in 1840, Presidency Bank of Bombay. So this is Presidency Bank of Bengal, and you can see in 3 presidencies. What are the 3 presidencies? Bengal, Bombay and Madras, right? Calcutta, Bombay and Madras. So 1840 in Presidency of the Presidency Bank of Bombay, Presidency Bank of Bombay. 1843 Presidency Bank of Madras. Okay, so these 3 by East India Company. Now these 3 banks were merged into which bank? Imperial Bank of India. Imperial Bank of India in 1921. Okay, so before RBI, this actually served as the central bank. Before RBI means till 1935. So till 1935, this bank was actually serving as the central bank. So after the independence, this was restructured into SBI. This was restructured into SBI in 1955. So Imperial Bank of India was restructured into State Bank of India. Okay, and in 1959, so some Associates, the government actually purchased these associate banks like State Bank of Bikaner, Jaipur, Travancore, Hyderabad, Saurashtra, etc. But all these are merged now, so we are not getting into that. Okay, so you give a heading nationalization of banks. Nationalization of banks. This is very important for your mains also. Right, in 1969, 14 major commercial banks having deposits of 50 crore, 14 banks having deposits of 50 crore or more were nationalized by the government. Nationalization means what? Government purchase all the shares of the bank. Okay, so that's what you mean by nationalization. So 50 crore or more were nationalized by the banks. So you can remember those names. You need to know that names from prelims point of view. Indian Bank, okay, then Bank of India, Indian Overseas Bank, and then Central Bank of India, then Union Bank of India, then United Bank of India. Okay, so what are common in these banks? What are common? Are you getting?
All are pan-India presence.
Yeah, not pan-India present. All the banks are pan-India. In the name, India is there. Okay, so that's how you can remember 1, 2, 3, 4, 5, 6 banks. The India is there in the name, and then region you can see, but not regional bank. I'm not talking about pan-India regional bank. Even Punjab National Bank is pan-India bank only. Okay, so next is Punjab National Bank. So Punjab National Bank. So you can see here this is a region, right? Then next you can write Allahabad Bank. So you can see again a region. Then Bank of Baroda. That doesn't mean that these are operating at the regional level. Okay, all are pan India, but you can understand easily all these are names attached with India, and these are attached with a region. So Allahabad Bank, then Bank of Baroda, Bank of Maharashtra. So these are the 4 banks which is associated with a particular region. Then you can write Syndicate Bank, United Commercial Bank, UCO Bank, or UCO Bank. You can simply write UCO Bank, Dena Bank, Canara Bank. So how many banks? 14. So these are the 14 banks. Yeah, these are the 14 banks which were nationalized. You write subsequently in 1980. Then later in 1980, government nationalized 6 more commercial banks. With deposits of 200 crore or more. With deposits of 200 crore or more. So first one among that, Punjab and Sindh Bank. Second, Andhra Bank. You write the names: Andhra Bank, Vijaya Bank, Corporation Bank, Oriental Bank of Commerce. Andhra Bank, Vijaya Bank, Corporation Bank, Oriental Bank of Commerce, New Bank of India. Okay, so six no, you got 6, sir? Oriental Bank of Commerce, New Bank of India, so you got 6. So in 1969, 14, now 86, so total how many? 20, right? And in this New Bank of India actually merged with PNB in 1993. So how many nationalized banks? Now? 19 nationalized bank now. What about SBI? SBI is a nationalized bank or not? No, right? SBI is a public sector bank. What is the difference between public sector bank and nationalized bank? Here when I'm talking about this nationalized bank, here 100% ownership is with the government. Now we are talking about, dilutions and everything, but here 100% ownership is with the government. So here public sector means simply more than 50% share is actually public sector. So when you talk about public sector banks, some more banks will come. Okay, in that IDBI will come, SBI will come, Bharatiya Mahila Bank will come. So like these 19 banks are anyway public sector banks. Then SBI will come. Okay, the Bharatiya Mahila Bank, these two are together now. And then IDBI will come. So SBI, Bharatiya Mahila Bank. So 19, then 1, and then 1, 21. So 21 public sector banks are there. So you write objectives of nationalization. Objectives of nationalization. First one, to promote mobilization of savings. To promote mobilization of savings by inducing trust of the public in the banking industry. By inducing trust of the public in the banking industry. So when it is with the government, the trust will increase in the financial institution, so that investment will be there. Okay, savings will be there. And that savings, who save? Basically the households will save, right? So households are the major savers. So savings and financial institutions are basically intermediaries, and they will lend it to the firms. So basically the role of financial institutions or banks are to mobilize savings and to give it for investment. So who will invest? The firms will invest. Who will save? The households will save. What is the role of financial institution? They act as the intermediary. Okay, that we will discuss in detail in financial institution. Second point you write, to provide social orientation. To provide social orientation to banking sector. This is one of the most important reason. Social orientation to banking sector. That is to ensure adequate flow of credit to weaker section. To ensure adequate flow of credit to weaker section. Okay. Third one you write, to expand bank branches, especially in rural areas. To expand bank branches, especially in rural areas. Okay, now you need to also write, if the question is asked, the achievements of nationalization, whether the objectives are met or not. Okay, also what was the failure. So just 1 or 2 sentences enough for your achievement, you can say. And you also need to talk about the failure. What was the issue with nationalization? So just write achievements or assessment. In assessment, you can write achievement first. Most of the social objectives of nationalization were achieved. So social objectives were achieved. That means you are started lending to weaker section. You are able to ensure credit to weaker section. You were able to expand the branches in rural areas, and all these things were achieved. Okay, so most of the social objectives of nationalization were achieved. After nationalization, there was sharp increase in bank deposits. You can write, after nationalization, there was sharp increase in bank deposits, rural branches, disbursement of credit to agriculture and rural sector. Disbursement of credit to agriculture and rural sector. So after nationalization, there was a sharp increase in bank deposits. So basically you are able to mobilize the saving. That's what you mean by bank deposit. Then you can say increase in rural branches and disbursement of credit to agriculture and rural sector. Now what was the problem? Failure. You write failure. After nationalization, the efficiency and profitability of banks declined drastically. The efficiency and profitability of the banks declined drastically. Because all banks started incurring losses, especially after nationalization. NPAs were increased. Okay, so that was the problem. It affected efficiency and profitability. You can also write what are the causes. Causes for losses. First one, what do you think will be the most important cause for this loss? The most important reason for the losses is actually the priority sector lending. We have discussed about this priority sector lending briefly when we discussed about some monetary policy tools. We have discussed this in the qualitative measures. I've briefly talked about this, so I'm expecting that you know this. So moving forward, priority sector lending. So because of that, what happened? Default increased. So priority sector, there is a chance that loan defaults are high. So NPAs actually increased because of this. Because of priority sector lending, NPAs actually increased. Just write what is one line about what is NPA, non-performing asset. These are bank loans. These are bank loans on which installment of principal or interest remain overdue for a period of more than 91 days, or for a period of 91 days or more. So NPA, these are bank loans on which installment of principal or interest remain overdue for a period of 91 days or more. So what about agricultural loans? Is there any different definition for NPA or the same in case of agricultural loans?
Yes, sir, there is difference.
What is the difference?
Definition of bank.
What is that?
So it depends on the period of crop. Actually, different for sugarcane, different for rice.
Yeah, it is actually one long duration cropping season or two short duration cropping season. You can write there in case of farm loans. In case of farm loans, in bracket you can write agricultural loans. In case of farm loans, NPA is a bank loan on which there is a default of one long duration cropping season or default over two short cropping season. Okay, so the main reason for the losses is actually priority sector lending. Next, you can write again over there itself, concessional rate of interest. Concessional rate of interest. Okay. Then the margin requirements, etc., which I have discussed when it comes to qualitative measures, that also if you want you can write, but the main reason is priority sector lending. You can write this concessional rate of interest also, and then cost of servicing of loan. Cost of servicing of loan increase. Next reason you can write, okay, so we are talking about the causes. Second cause, high CRR and SLR. High CRR and SLR. Okay, so it was like before, it was like 15%, okay, CRR, and around 38.5% SLR. If you see in 1991 during that time, this was the situation. So you can see here more than half of the money which is coming to the bank, like this is around 40%, so around 54% is actually got stuck with the bank. So for this there is no return at all. So this 15% CRR, there is no interest paid. In case of SLR, it is maintained in GSEC, so you may get some return. But actually if you speak, 54% is actually stuck for the bank. Bank can now lend only 46%. So what will happen? Obviously the profitability will come down, and that is a second reason. Okay, so high CRR and SLR. So here you can write one more line under this: the scope of profitable lending came down, or the decreased. Scope of profitable lending decreased. So you can see here now the issue is more because of priority sector lending also. So already, let's suppose 100 crore is coming. Okay, 100 crore is the deposit. or demand time liability. So if bank is having 100 crore, 15% is gone. That is 15 crore is gone as the CRR. Okay, so 15 crore is just kept as CRR, then 38.5 crore for SLR. Then 40%, what requirement you have to meet? PSL, priority sector lending requirement also you have to meet. Then what is left out? Nothing left out, no? See, after keeping this, how much you can lend? This is around 53.5% is gone. How much is left out? So 46.5% is left out. Out of this 46.5%, 40% is gone for PSL. Only 60% of 46.5. 60% of 46.5, that is around 27 crore. So out of the 100 crore, only 27 crore is the profitable lending. PSL lending, not profitable. This CRR, no interest only, no interest bank is going to get. SLR, not at all profitable, it is the government security. So only 27 crore, that is hardly around, like 27% is what your profitable lending. You got it? So that is also one of the reason, high CRR and SLR. Third point you write, lack of autonomy and accountability due to excessive political intervention. Lack of autonomy and accountability due to excessive political intervention. Okay, see, various governments will come and they will, even during election time also, they will offer loan waiver, etc. Right? It is actually a stress on the banks. So loan waiver and all this it is a political interest, right? See, you gave two options to the politician. One option is you strengthen the bank. Strengthen the bank. The other option is you strengthen your vote bank. What the politician will see? The politician will be interested in this only. So if the politician is interested in this, what will be there? Loan waiver, right? So this is actually going to create problem for the bank, and that is also one of the reason for the losses. Then other problems you can write: overstaffing, trade unionism, poor customer service. It's a public sector bank, so poor customer service. All these things you can write. These are common things. So all these things should be there in case if the question is asked on nationalization. So even if it is a mains question, you don't want to write which all banks are nationalized, but you just need to tell when was the first nationalization, when was the second nationalization, what was the objective and the assessment part and the failure part and the reason for failure. Okay, and that should be your answer if the question is asked in mains. Prelims, what they can ask you is regarding what all banks, etc. can be asked. So next you give a heading: banking sector reforms. Banking sector reforms, again very important from mains point of view. Even though this Narasimham committee, which was in 91, one more committee is there, Narasimham 1 and Narasimham 2, one is more important. We will discuss both. Okay, so first you give a heading: Narasimham committee. Narasimham committee. Okay, you give under that you can write: in 1991 government set up the Committee on Financial System. The name of the committee is the Committee on Financial System. The Committee on Financial System under the chairmanship of Mr. M. Narasimham, former governor of RBI. So Narasimham was the chairman, who was a former governor of RBI. And this is very important because most of the recommendations were actually accepted by the government. Okay, so we can see the recommendations. The first one you can write: RBI should reduce CRR and SLR in a phased manner. So CRR to be decreased, SLR to be decreased, and in a phased manner. So what is CRR now and what is SLR now, that you can refer. Okay, so that is the first recommendation and this is accepted. Okay, so I have told you already CRR in 91 was 15%, SLR was close to 40%. Now you can see CRR 4%, right? So it is reduced, it is accepted. Second one you write: the PSL quota. the priority sector lending quota should be reduced from 40 to 10. 40 to 10. Is that accepted?
No, sir.
No, this is not accepted. Even later in 2014, there was another committee, 2013 or 14, we'll see that Nachiket More committee. It says it should be increased to 50%. So Nachiket More committee, we will see after some time when we proceeded with this discussion. So here 40 to 10, this is not relevant also. You don't want to, I just told you one of the recommendation, not relevant, not important. Third one you write, the RBI should grant licenses. The RBI should grant licenses to new private sector and foreign banks, to new private sector banks and foreign banks, to promote competition. To promote competition. Okay, so you can see in 94, which major private sector banks came? 94, ICICI Bank, HDFC Bank, UTI Bank. What is this bank, UTI Bank? Is this bank is there now? Or the name was changed?
The name is bank.
This is Axis Bank. Okay, UTI Bank is the Axis Bank. So then foreign banks, if you see Citibank, HSBC Bank, okay, HSBC, Citibank, etc. So were given the license. And again, if you see during this time, during this time 2001 to 4, there are other banks like Yes Bank, Standard Chartered Bank, Kotak Mahindra Bank. All these banks were also given license. So is it accepted or not? It is accepted. Okay. So private sector banks and foreign banks were given license for promoting the competition. In 2013 also some banks like Bharatiya Mahila Bank, okay, it was a public sector bank, I've told you already, Bandhan Bank, and then IDFC Bank. Then in 2015 there were some licenses to differentiated bank. I will discuss about what is differentiated bank. These are the payment banks. I'll discuss this, okay. We will do separately. Similar to banks, but not all functions of banks. You just hold on to this. I will discuss this later. Let's now discuss about this particular thing. Narasimham committee. Okay, next point you write, RBI should adopt Basel norms regulation of banks. RBI should adopt Basel norms regulation of banks. What do you mean by Basel norms? How is it calculated? Even the mathematical formula also we will discuss after some time in this module itself. Now we accepted that, okay. So we are following Basel norms. In fact, we are following one step ahead. Whatever Basel norms are saying, plus one is our norms, okay. So it is even more stringent than Basel norms. Okay, next point you write, the public sector banks should be granted more autonomy. The public sector banks should be granted more autonomy. Public sector banks to be granted more autonomy. Next point, banks should use information and communication technology and automate their operation. These are anyway not relevant now, but just write there. Banks should use IT and automate their operation. Core banking solution, CBS, core banking solution. Core means centralized. You can write there core, that word means centralized online real-time environment or exchange. Centralized online real-time environment or exchange. So this is the core, okay. So core banking solution, CBS, like internet banking, etc. All this will come here. The next point you can write, banking ombudsman should be established. Banking ombudsman should be established for expeditious resolution of grievances of bank customers. For expeditious resolution of grievances of bank customers. So there should be a banking ombudsman. Banking ombudsman. Okay. Next point, debt recovery tribunal, DRTs. Debt recovery tribunals. Debt recovery tribunals should be established to enable banks to quickly recover dues from defaulters. Debt recovery tribunals, DRTs, should be established to enable banks to quickly recover dues from the defaulters. Next point, asset reconstruction company, ARC. There is another ARC that we will discuss under ethics and governance, that is different, this is different, okay. So this is asset reconstruction company or fund. Asset reconstruction company or fund should be established. Asset reconstruction company should be established. What about this asset management company, AMC? Have you heard this name somewhere? Any idea about this asset management company?
IBC, they manage the assets.
Yeah, when we talk about the mutual funds, we will discuss this. There is a asset management company who will be taking care of the assets. Okay, assets means the shares, bonds, etc. They take the decision. Okay, we will discuss that when we discuss about mutual funds in financial institution module. So here, asset reconstruction company should be established to purchase non-performing assets of banks at discount. To purchase non-performing assets of banks at discount. See, the problem with debt recovery tribunal is, if bank go with this, it is going to take a lot of time. You know, there is a tribunal and the case will be there, so it is going to take a lot of time. So instead, what banks can do is, bank can sell the NPA, so NPA to ARC. Now ARC will recover it from the loanee, and ARC can only recover through legal means. You cannot send goons and all to get this money. So otherwise bank have to be behind this if it is directly DRT. So instead bank can sell this to ARC at a discounted price. So some discount will be there, and this ARC can recover it from the other party through legal channels. Okay. So actually government also established one ARC, ARCIC, the Asset Reconstruction Company India Limited. This government's ARC established in 2002. Asset Reconstruction Company India Limited was established in 2002. Now other companies also have other companies also there, Asset Reconstruction Company in the private sector. So what they do, they will buy NPAs from the bank at a discount, and they spend the time and they will recover it from the party. So when they recover, they can get that difference, right? Whatever discount that they got, that difference is their profit. So that is what the principle behind Asset Reconstruction Company. Now recently 100% FDI is also allowed in ARC. Okay. Next point, RBI should deregulate interest rates. RBI should deregulate interest rates. What do you mean by deregulate interest rates? Yeah, earlier RBI was fixing the interest rate even upon the savings account also, but now banks are given the freedom to fix it, but there are conditions, not completely. For example, 2011 onwards, savings bank account, you know, the bank's respective bank can fix. RBI will fix the minimum, let's say 4% or something, this RBI will fix, and upon that the respective bank can give whatever they want. For example, Yes Bank is giving 6%, Kotak Mahindra also giving like that. So SBI will give 4%. So that is the minimum which is actually fixed by the RBI. So this question was actually asked in 2009 also. This question. In 2009 question was, who fixes the savings bank, you know, interest rate? Government, RBI, banks, and something like that. Options was there. So what is the option? What is the answer?
RBI.
In 2009 it was RBI. At that time it was RBI, but 2011 it was changed to bank. So if you see the previous year papers, okay, you may see RBI, but that is that year's answer. Now it is actually the respective banks will fix the interest rate. So this is one of the recommendation, and to an extent this is allowed also, accepted also. Under that you can write the first point, under this deregulation, RBI deregulated interest rates. RBI deregulated interest rates on all loans of rupees 2 lakh or more. Of rupees 2 lakh or more. Okay. Second point you can, so that means 2 lakh or more RBI deregulated. Okay. Second point, why? What is the logic? Less than 2 lakh, it may be the poor people who take that loans. So RBI did not deregulated that case. Second one, in 2011, RBI deregulated interest rates on saving account deposits. Interest rates on savings account deposit, as well as deposits of. Okay, in 2011 RBI deregulated interest rates on saving account deposits as well as deposits of non-resident Indians, NRI external rupee account. I will explain about this. NRI non-resident external rupee account. See, NRI account, there are of two. NRI account, if you see, there are two types of account. NRI accounts. Okay, first one, this is what we have discussed. NRI, okay, external rupee account, and then you have FCNR, foreign currency non-resident bank account. So just write there, foreign currency non-resident bank account, FCNRB. This is NRI external rupee account, then FCNRB. So here in 2011 RBI deregulated interest rates on savings account deposits as well as deposits on this one, not this one. Okay, so we will just deviate from here, and you can say here the first one, this one is actually maintained in rupee. This account is actually maintained in rupee. Okay, so this account is actually maintained in hard currencies like dollar, pound, any hard currencies. So here you can write these are maintained in hard currencies. So let's say if $100 is deposited. Okay, let's say $100 is deposited, and let's say 67 is the market value of dollar. So what will happen is, in this account directly the market value will be credited, 6700 will be credited. But here FCNR, it is directly $100 will be credited. Okay, so here that converted and it will be 6700. Here direct $100 will be credited. Now in this account, the first account that we are talking about here, interest is paid in rupee, because you can see here now the amount is correct converted to rupee. So interest is paid in rupee. So here interest is paid in dollar. Now when he withdraw from this account, he can withdraw in dollar, but when he withdraw in dollar, he will get the market rate at that time. So when he invested it was 67, when he deposited it was 67. Now he can withdraw, he will get in terms of dollar. So what will happen? Let's say he deposited $100. Now imagine rupee depreciate. So will he get more than 100 or less than 100? Rupee depreciated, so will he get more than 100 or less than 100? The same amount, he did not withdraw the 6700. So when he invested it was 67, so it was credited 6700, and interest is paid in rupee. Okay, and rupee depreciate, so will he get more than 100 or less than $100?
More than 100. Less than 100.
Rupee depreciated means, let's say 67 to 75.
Less than 100.
So you will get less than $100 because rupee depreciated. So now $1 is 75. So if you need to get $100, you need to pay 7,500, no? But you have only 6,700 here. So when you withdraw, you will get less than 100. Similarly, if rupee appreciate, you will get more than 100 in case of appreciation. In case of depreciation, less than 100. In case of appreciation, more than 100. So depreciation and appreciation will play a role here. Okay. And now, since it is in rupee and all, he may spend some money in India. So it won't go back completely. Okay. So that is why RBI is allowing in this account the interest can be fixed by the banks. So this account is actually deregulated. You got the logic. So here it is converted to rupee. So this may be used in India only mostly. Okay. What about this? This is not deregulated. So not deregulated means who fixed the interest here? Who will fix the interest here in this account? FC and RB.
RBI.
RBI will fix. Banks are not allowed, but here banks are allowed to fix. So FC and RBI, it is RBI will fix the account. Why? The main reason is whatever is coming to this account, it can be completely repatriated. It can be taken back anytime. Okay. And $100 is there. $100 will be taken back anytime. So, and only here some more regulation is there. Only fixed deposit is allowed in this. Only fixed deposit is allowed. Otherwise, what will happen? Any idea? Why only fixed deposit is allowed? Volatility, right? You can invest today and you can withdraw that tomorrow. So that will be volatile. That will create volatility in the market, forex market. But here in this account, it is actually savings are allowed. Fixed deposit is allowed. Recurring deposit is also allowed. It is similar to normal account in India. This is NRI account. Both are NRI account, but this NRI account is similar to the normal account. Interest is fixed by the banks. It can open savings. It can be fixed deposit. It can be recurring deposit also. Here only fixed deposit, FC and RB. You got it? See, in the first case, it is almost like you are coming with some dollar. And imagine that you exchange dollar somewhere and you got 6,700 and you deposited in the bank. Instead, what you are doing, you are depositing the same dollar in the bank only, and your same will be converted, and you are paid interest in terms of rupee. And then when you go back, you will be getting that in terms of dollar. Exactly the same thing. Otherwise, you can imagine like this. You are coming from abroad. You have, let's say, $100. You exchanged it with some other agency, and then you deposited 6,700. You got interest in terms of rupee just like normal, and then when you withdraw, you get 6,700. But at that time, rupee depreciated means you will get less than 100 when you convert it with some other agency, and if rupee appreciated, you will get more than 100 with some other agency. Same is the case done by banks. That's it. So it is similar to the normal account, but here only fixed deposit. Interest is not deregulated because it can be repatriated anytime, hard currency, and that can create volatility in the forex market and all. So that is why some restrictions are visible here, FC and RB account. So I just deviated here. We will come back to what we were discussing. We were talking about, RBI should deregulate interest rate. Under that you can write one more. 1, 2 you have written. Third one, RBI permitted banks to determine their own benchmark prime lending rate. Their own benchmark prime lending rates, BPLR or PLR. BPLR, benchmark prime lending rate or prime lending rate. Okay, so you just write what is PLR, prime lending rate. You just write one line over there. It is the rate of interest at which a bank lends to its most credit-worthy borrowers. Most credit-worthy, in bracket you can write prime borrowers. Okay, that's why prime lending rate. This is the interest rate at which like 9%, 8%, etc. This is the rate at which you will lend to the prime customers like TCS, Wipro, Infosys, okay, all this Reliance, etc. all these companies. So that is why prime lending rate given to the prime customers. Okay. It is the least rate of interest. It is the least, in bracket you can write floor rate of interest. It is the least, or in bracket floor rate of interest at which a bank lends on commercial basis. A bank lends on commercial basis. Third point you write, it served as benchmark. It served as benchmark or reference rate of interest. It served as benchmark or reference rate of interest. That means it served as reference rate of interest for charging interest from other customers. Charging interest from other customers. So is that okay? So this is a interest rate which serving as interest rate of other, based on the reference of this only, interest rate of other customers. Like for example, RBI say interest rate for SSI, small scale industries, should be PLR plus 4%. Like if prime lending rate is 8%, it should be 8% plus 4%, that is 12%. So this will actually serve as the reference rate of interest for others. But do you think banks are interested in giving loans to small scale industries at 12%? But they are ready to give at 8% for the prime customers. There is no doubt in that, because obviously there is a safety, security and all those things are there. So banks are willing and ready to give at 8% to the prime customers, but small scale industries, they are not willing. They may not give. Okay, so what they did is, so this is prime customers, right? They created another category. The bank said the best of the best. Okay, the best of the best. That means for them it is 8% and the best like 12%, and that comes under RBI definition, this one. So because of this issue from the bank side, RBI has actually replaced it with base rate. Now all these things are not important. Now there is another concept is there. That is what I'm going to discuss now after this. But I'm saying initially BPLR, then it was replaced with base rate in 2010. Okay. So here this is a best borrower. In case of prime lending rate, it was considered as a best borrower. But banks introduced a category of best of the best. And they started lending at very low percentage for them. And for the best borrower, it is 12%. So as per RBI definition, 12% for 4%, it will be 16%. So that is okay for small scale industries, for banks. You got the idea why I said the best and the best of the best concept. Okay, now base rate. You can write what is base rate, 2010. Base rate, it is the rate of interest at which bank lends to its prime customers. Bank lends to its prime customers. Its floor and benchmark, it is the floor and benchmark rate of interest. And banks are prohibited to lend at an interest rate which is less than the base rate. Now you cannot lend less than this. Earlier also I have told you PLR should have been served as the floor rate. But the problem is, they created another category, best of the best category, and they started lending at a lesser rate, like 8% for them. Okay, but here it is made clear that banks are prohibited to lend at an interest rate which is less than the base rate. Now one more line, how you fix the base rate. Banks have to fix their base rate. Banks have to fix their base rate on the basis of their cost of raising funds, which include interest paid to depositors, because banks get money from depositors. So cost means the interest paid to the depositors plus operational expenditure like staff salaries, rent, etc., and their own profit margin. So interest of the depositors, operational expenditure, and the profit. So taking into consideration, now you will decide a floor or the base rate or the benchmark rate, and that is what the base rate. Okay, and below base rate you cannot lend. Okay, so it is prohibited to lend below base rate. Okay, any doubts? So tomorrow I will discuss about MCLR, marginal cost of funds based lending rate. That is actually replaced, this base rate is actually replaced with MCLR. So I'll discuss this concept tomorrow in detail. If you have any doubt, now we can discuss.